Hello and welcome to Livewire's Buy, Hold, Sell. My name is Chris Conway. Great income stocks not only pay a reasonable yield, but they grow that yield over time. Today we're running the ruler over 5 stocks with above average yield, so better than the market, and that are expected to grow their dividends over the next couple of years. Helping me with that is Sean Roger from Perpetual and Peter Gardner from Plato. Ladies and gentlemen, the way that we found these stocks is I ran a little screen for a market cap above $1 billion, 1 year forward yield above 4%, so better than the market, as I said, and dividend per share growth expected over the next couple of years. The first name to make the cut is Aurizon. Sean, I'll come to you. Buy, hold, or sell?
So sell. I think the below rail coal business is a high quality asset. I guess the concern or the question mark we've got is the rest of the business. I think the above rail coal business has got about 50% of its contracted volumes up for expiry over the next 2 years. I think the environment's pretty competitive at the moment, and even if they do retain all of those volumes, there's a risk that you see the margin come under pressure as those contracts sort of roll through, and I'm just not sure that's reflected in forecasts if that does play through that way. A good example of that was we had Whitehaven on their call, results call just recently, talk about the benefit they're going to get. I think it was $3 a tonne benefit from a new contract that's rolling, starting 1st of July next year. And I think that's just evidence that there is a bit of pressure there on these contract rolls. So that's one thing we're thinking about. And secondly is the above rail bulk business, the One Rail acquisition, still yet to prove that it's going to be able to earn an adequate return on capital. So look, the dividend yield is quite attractive. Bit of leverage on the balance sheet, and it's a pretty full payout ratio. So for us, just given that early question mark around the coal business, just a little bit of uncertainty there for us, so it's a sell.
Yeah. Pete, 1 year forward yield of 5.6%, so relatively juicy, up 26% over the last year. Buy, hold, or sell for you?
It's a buy for us at the moment. It's obviously one of those mining service contractors. It's probably not our favourite mining service contract that we've got in the business, railway. As Sean says, there are some challenges kind of in the next couple of years with redoing the contracting. But given the way that the mining business is going at the moment, it's on a decent yield. It looks good value. It's forecast to grow, not by a lot, so in kind of mid-single digits for the next couple of years. But given where the yield is, we think it looks decent value, so buy for us.
Next up, we'll talk one of Australia's favourite retailers, JB Hi-Fi. Haven't changed their stores in 20 years, but we still all go there and buy their stuff. 1 year forward yield of 4.35%, expected to grow. Solid results, up 7% on the day thereof. Pete, I'll stay with you. Buy, hold, or sell?
It's a buy for us. JB Hi-Fi has been under some pressure recently with the kind of projected interest rate rises as inflation started going up at the end of last year. Share price started coming under pressure, but its sales have still remained pretty buoyant in that environment. So sales were up 7% in the last 6 months and then up 4% for January. So they have come off a little bit, but yeah, it's a kind of category killer in that space as well. It's doing incredibly well. I think of it more of a consumer staples business at the moment. I think the last thing that most young people in particular are going to stop spending money on is their phone and their electronics. And so we think even in a kind of interest rate increasing environment, it'll stay fairly buoyant.
Yep. Sean, Pete alluded to it. Tough 12 months, down 9% in terms of share price. Buy, hold, or sell for you?
Yeah, I'm going to agree with Pete and say buy. I think the sectors that JB Hi-Fi and the product categories is exposed to got a bit of a structural tailwind there. You've just got an ever-evolving new roadmap of new technology products sort of coming out. And also, I think if my household's anything to go by, there's each person who sort of seems to have more technology products per person. So ultimately, I think they're in pretty attractive categories in consumer electronics and small appliances. It does feel like Harvey Norman's got his mojo back a little bit in the last 12 months. So I think the competitive environment, there's probably not as much market share gains there as there was for JB Hi-Fi. But given its starting yield, very, very strong balance sheet. So I think you'll probably see you might see some specials there to sort of on top of the ordinary dividend. So for us, it's a buy as well.
Next up, we'll talk a Transurban. 1 year forward yield of 4.79%. Again, expected to grow thereafter. Boring is beautiful, Sean. Buy, hold, or sell?
I'm going to say sell. Obviously, a great set of concessions here in Australia, and I think the pricing escalators embedded within those concessions provide really good inflation protection and ultimately growth for end shareholders. You step back though, at the end of the day, what they own is concessions for toll roads, and Transurban gears these up during the ownership of the concessions and then ultimately has to pay down that debt to hand back the concession at the end of the period. The company's done a fantastic job over the last 10 years getting extensions to those concessions and also diversifying through acquisitions. But there's a couple of things that have, I guess, popped up over the last few years that in our view may make it more difficult to replicate that in the future. The first one is the ACCC blocked them from making an acquisition in Melbourne. And secondly, obviously, the toll review that's going on in New South Wales just sends a bit of a signal that the overall level of tolling has reached a point that maybe consumers are not overly happy with. So the dividend yield, just under 5%, is actually towards the sort of upper end of where it's traded historically, but just those question marks around, I guess, that medium to longer term ability for them to replicate what they've done historically makes it sell for us.
Pete, up 8% over the last 12 months. Buy, hold or sell for you?
It's a hold for us. I agree with most of what Sean says. I think there's a few extra points worth noting. Its average concession life is 28 years, so it's got those assets for a very long period of time, so they will run off at some point. But that's a fair way down the track. It's on a 24 times EBITDA multiple, which we think is probably reasonable for a stable business as it is. There is kind of regulatory concerns, but there's not too much the governments can do because they've already negotiated those contracts, and so they kind of have got to pay out Transurban if they want to try and reduce that tolling going forward. So we think it's kind of a stable business, especially in this kind of everyone's worried about AI. Unless you think that we're all going to go into the metaverse and put our Google goggles on and no longer use roads going forward, we think that growth will continue going forward. But yeah, it's expensive, so yeah, it's a hold for us.
Yeah. Next up, we're talking Computershare, 1 year forward yield of 4.03%, but the share price has taken its lumps both over the last month, down 11% and 27% over the last 12 months. Any value there, Pete? Buy, hold or sell for you?
Yeah, it's a buy for us at the moment. The thing about the Computershare business is they do investor services, but they're also very exposed to what interest rates are going to do. So when interest rates are going up, they get a benefit. When interest rates fall, they take a hit. Now, they tried to point out in their update they had that they do have some opposite kind of effects to that. So when interest rates fall, they should get more deals coming through, but it definitely won't offset that. So your view on this company is definitely based on what you think about interest rates going forward. We think in Australia at least, the interest rates look like they're going up over the next year, so it's a buy for us.
Sean, what about you? Buy, hold or sell for Computershare?
Yeah, hold for me. The company has done a pretty good job over the last few years managing and terming out that margin income. So I think it's perhaps not as sensitive to rate movements as it once was if we do end up with a sort of rate cutting environment. And I think the core business had a tough couple of years during COVID, but is starting to pick up on the back of sort of improved capital markets activity. The thing that sort of holds us back is we're starting to see in the US a bit more chatter around tokenization. I think you've had the New York Stock Exchange announce that they're looking at launching a 24/7 trading market that's got instant settlement, and a lot of, I guess, runway there and things to fall into place for that to happen. But I think if it does, there's just a bit of an uncertainty as to how it impacts parts of Computershare's business. So it's a pretty attractive yield. And I think it's relatively sustainable for the next few years, but just with that question mark there, it keeps you on the fence.
Yeah. To close out, ladies and gentlemen, we're going to talk about the Lottery Corporation. Who doesn't love a punt, especially when the jackpots are pushing $80 to $100 million? 1 year forward yield of 3.1%, growing to 3.55 and then 3.85 over the out years. Sean, buy, hold or sell for you?
Yeah, it's a buy for us. So look, really like the lottery category and asset class. I think it's shown over time that you do get periods of volatility with jackpots, but it does tend to have pretty solid sort of growth over the longer term. Fertility, it owns obviously a near monopoly in Australia with pretty long dated concessions apart from Victoria, and it's got a really nice growth sort of algorithm where you do have sort of mid-single digit top line growth with turnover and a little bit of price, but they've got this really nice structural tailwind to their margins, whereas more people buy tickets online, the margins are much higher because they're not paying commissions to the retail agents. So you can sort of get to that high single digit growth, which we think is sustainable for a long period to come. I do think with the potential for the Victorian licence, which is due to expire soon, it could be an opportunity for the company to increase their sort of target leverage range. So I think over time there is scope with the earnings growth and potentially for that dividend yield that you mentioned to sort of increase over time. So it's a buy.
Pete, up 7% over the past year. Lottery Corporation, buy, hold or sell for you?
Yeah, it's a buy for us as well. If you look at their recent result, they did really well in Keno, where they got a good lottery outcome, so some good jackpots there. But in terms of the major part of their business, they actually had quite a tough jackpot period, I guess. There are a lot fewer jackpots than there normally is. And so we see that bouncing back next year if kind of luck goes back to their way. And so we see a good increase in profits next year and so an increase in dividends as well.
There you have it, ladies and gentlemen, a nice double buy there to finish on. Huge thanks to Sean and Pete for this entire income series, special episodes of Buy, Hold, Sell. If you enjoyed this episode, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.